Hey guys, Jonathan Rose, owner, Masters in Trading. We're going to talk about scalping S&P futures. Let's get going. Okay guys, so in front of you, we have our proprietary tool. It's called Equity Edge. Very simple, very straightforward. The red line, S&P futures. The white line, Nasdaq futures. Up above here, these are just implied volatility bands of the at-the-money straddle in the future. The futures at-the-money straddle. So the red is the at-the-money straddle of the S&P futures, top and bottom. The white is the at-the-money straddle for Nasdaq futures. We're just looking at a week's worth of data. I put the data box on right here so you can see, for instance, right here, Nasdaq's pretty much at the 0 line. S&Ps are at the 2,000 line. The Nasdaq upper is about 9,000, and the S&P is about 6,700. So I'm a big believer that people make trading way too complicated. We want to simplify things. So these bands, which are just again the at-the-money straddle, which are naturally going to have resistance and support, we just want to trade around those bands. And you can see the behavior this week. Market ran up, S&P and Nasdaq, they moved up, pretty much together. It looked like here S&Ps were definitely stronger, leading the way over Nasdaq, but Nasdaq caught up right here. What I would do is I would have definitely wanted to be long the white, right? Why buy S&Ps when Nasdaq going back, and this is only a week chart, but the relative difference, Nasdaq was far weaker. They both rallied up right up to that S&P line. They got to that S&P line on Wednesday, hung out, tried to get there a little bit, got a little toppy, and then sold off. Keep it nice and simple. Really, there's nothing to do here. When they break apart, you may have a trade, but as the market rallies, and I think most of us believe with all the trouble in the world that this rally lately is getting a little overextended. So where do you get short? Well, on the weekly chart, we got right up to that implied. It's right at that $6,500 level right here, and then it sells off. How this works is if you would have sold a one lot of the white line, the Nasdaq futures, or if you would have sold a one lot of the red line, the S&P futures, instead of looking at ticks or the price of the index, we look at everything based on P&L. I want to know that if I sell one here and I buy it back here, I don't really care how many S&P points that moves. I want to know how much money I make. And if you sold here and bought here, you would make about $7,000. If we go to the previous week, and I just put this on a weekly, these are weekly, we call them cycles. So we start a new game every single week. You can do a cycle for a month, for a year, it doesn't matter. But the previous week, you can see, again, moving in tandem. It looks like here the S&Ps were a little weaker. Nasdaq took a little bit longer to sell off. And here Nasdaq sold off more than the S&Ps. So a relative value trader selling the white, buying the red, well, look at it here. At this level, the Nasdaq was 1,000. S&Ps were about break even. And at this level down here, Nasdaq is down 7 and S&Ps are down 6. So here there's about a $1,500 difference. And here there's about a $1,000 difference. So the spread has about a $2,500 difference. But again, here they trade together. Oop, get him real close. Get him real close. You can see it bounces. A really simple, straightforward way to look at the market. But again, it's okay, guys. Keep things simple. My name is Jonathan Rose. This is Equity Edge. Email support@mastersinTrading if you have any questions. Thanks for watching, guys.